Hey everyone, New Holdings is a digital financial services company based in Latin America that operates primarily in Brazil. In this video, I'm going to review the company and answer if investors should buy the stock at current valuations. I'll review the latest quarterly investor update. I'll weigh it against its valuation, look at the prospects over the next year, and answer if I think investors should buy this digital financial services company that I think of somewhat like the Sofi technologies of Latin America. That's primarily the good comparison on a US-based business to look at New Holdings with.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in its latest quarter, the company added 5.5 million new customers and 20 million customers year over year. It now has a total of 99.3 million customers at year end. But it's not one of those unprofitable growth stocks, right? Net income increased to 378.8 million, and that was more than double the 141.8 million in the first quarter last year. Part of the reason the company's growing profitability is because the monthly average revenue per active customer increased by 30% to $11.40. So not only are they adding tens of millions of new customers, but existing customers are increasing the contribution revenue to the company. So they're getting more revenue out of existing customers and they're getting millions of new customers. A strong 1-2 punch for growth longer term. Customer deposits increased by 53% to 24.3 billion. That's a robust balance of customer deposits for a company with 100 million, roughly 100 million total customers. So as with many banks, the big question mark is how much money can they make from the difference between how much they earn from lending and how much it costs them to secure deposits, right? That's the net interest margin, or NIM as it's called. Okay, that's the business banks are in, getting money from depositors and lending money to borrowers, and how good they are in that job. Okay, that's the primary role of a bank. And so for New, their risk-adjusted net interest margin reached 9.5%, which is a really good net interest margin. That was 70 basis points lower from the previous quarter. And that was mostly driven by higher funding costs in Mexico. So Mexico is one of the newer markets it's operating in. It gained great traction there, adding more than 1 million customers, but it's higher funding costs. So it's costing the company more to attract those deposits. But still, the net interest margin increased by 3.2 percentage points year over year. So still growth year over year, but down from the previous quarter. Digging deeper, you'll notice that the active customer count, which is different from the total customer count, these are customers that are engaged, not customers that have signed up and perhaps never again engaged, or maybe engaged a couple of months ago, aren't really actively using this account, which is not very profitable for New. The active customers are the more profitable customers. And this increased to 82.6 million at the end of the first quarter. And that was up from 64.9 million in the first quarter last year. But more importantly, it was up by 4.6 million from the previous quarter. So excellent growth here, regardless of which metric you use to look at New Holdings. They are demonstrating growth in customer counts, active customer counts, robust growth across the board. And we already talked about the monthly average revenue per active customer. It was $8.60 in the first quarter of 2023. And that increased to $11.40 year over year. But even from the previous quarter, it increased from $10.60 to $11.40. And that's a interesting and solid growth, but especially when you compare it to the monthly average cost to serve these customers, it was just 90 cents. So This is where that digital strategy is paying off, right? If you have brick and mortar locations, your cost to serve customers will be higher. It'll be easier to attract customers because brick and mortar locations have a tendency to attract people to walk in. But to serve those customers will be much more expensive because there's maintenance, there's labor, you got to employ people there. And so the costs are higher. And when people walk in to deposit checks and withdraw money, all of those transactions require consumer-facing individuals, and those are costly. And so without that, you're able to generate stronger profit margins because you're digital only. All right, so the company's portfolio of loans mostly consist in credit card and personal loans, which makes it more risky than a traditional bank that consists more so of mortgages, maybe car loans, and then maybe some personal loans and credit cards. But New has $19.6 billion in credit card and personal loans. That was up from $12.8 billion in the same time the prior year. And compared that to their deposits of $24.3 billion. Now, there's the good and bad with having a credit card and personal loan portfolio. The good is that these are higher interest earning assets. When you make a credit card loan or personal loan, those come with higher lending rates, right? Versus a mortgage that comes with lower rates. A car loan comes with lower rates because those have collateral behind them, and so lenders are willing to lend at lower rates. But with these loans, they come with higher rates, but they're more risky. And let me share with you the risks. All right, so New Holdings gave us their non-performing or delinquency rates, and you can see these trends are not working in its favor right now. Delinquency rates are at record highs for New Holdings. In the most recent quarter, for the Brazil consumer credit portfolio, the 15 to 90 day non-performing loans reached a record 5%. That's the highest going back all the way to the fourth quarter of 2017. And it's trending much, much higher. And the 90-day plus non-performing loans is also at a record high at 6.3%. And that's a record going all the way back to the fourth quarter of 2017 as well. And the delinquency rates are only increasing. So this is the risk. This is the primary risk here with New Holdings, is the portfolio of loans are riskier than usual, and they're defaulting at a much higher rate and then even in before the pandemic. So that's something to keep an eye out for with New Holdings. Now, the stock has been rallying since 2020, since the start of 2024, probably longer back. If we go back, I can show you a history here. If we go back all the way to 2023, the stock has rallied from about $7 a share all the way up to $11.63 a share. It's now trading at a forward price to earnings of 18.18. So the company is demonstrating excellent growth in customers, in the average revenue per customer, and in growing the total deposits at New Holdings. The risks are that the default rates are increasing and the company holds a portfolio of higher than average risk loans. To put it all together and to answer whether or not I think New Holdings stock is a buy, hold, or a sell, I would put it on the borderline category of buy and a hold. I like the growth. I like the digital service. I like the millions of new customers. I like the increasing spending per customer. However, I am concerned with the default rates rising to record highs and trending worse. So those forces offset each other, along with the valuation that's already gotten stretched because the stock price has increased from around $7 a share to over $11 a share in a little over 9 months. So for all those reasons, I'll put it on the borderline. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.